Hey, good morning, everyone. Marty Missouri here, the 12th of July, 2025. Just popping in to offer up an additional commentary here this weekend based on what I'm looking at as I look through all the charts that I go through over the weekend. And essentially what I want to do is put some visuals to what I keep saying about the upside risk to inflation and to interest rates, given all that's going on, particularly in the U.S., and particularly with regard to new legislation that was just passed. And again, the point I keep making is that in an environment that is not recessionary, now we have some serious concerns about risk of recession going forward over the next few months, but still, without doubt, we are not in recession currently. So if we stimulate amid a time when inflation is still running too hot and could potentially ramp back up, got to be careful with that, right? There are some risks there, and I want to just briefly express what those risks look like and how they manifest in the financial markets potentially, okay? And again, all I'm doing is just trying to help you make sense, because as I listen to the news and I listen to all the rhetoric, a lot of it conflicts with what I'm saying, right? The Fed needs to cut rates by 2 or 3 percentage points and so on. And I just want to express why timing is everything when it comes to these things. And really, of course, this is for clients to help you understand what you're seeing in your portfolio as we adjust to ever-changing, short-term conditions for sure. Longer term, we have what we believe to be a pretty solid thesis, but we believe that we are still embroiled in the very later stages of the current cycle, which demands a shorter-term tactical approach to portfolios, and I think it demands, hedging and the kinds of things that we do. Okay, so on your screen is one of the inputs to the inflation element in our own index that we call the PWA index. And what this is CPI swap rate. This reflects, some would say, market expectations of what inflation is, and I think it does, right? But technically it's the compensation for those who are hedging their inflation risk. Essentially gets captured in this data. So the blue line is the 2-year inflation swap rate. The yellow line is the 5-year, and the green line is the 10-year. And I just wanted to point to what's been going on there since the passing of the big beautiful bill. And that happened it was officially on July 3rd, which would be about right in here. So here's my point. Inflation, let's say inflation expectations, I'll go ahead and say that, have spiked notably since the act was passed. The 2-year yield, the yield on the 2-year Treasury, which is considered a direct reflection of where Fed funds rates are going, you can see in the futures market exactly what happened the moment it was announced, the moment the approval happened in Congress. You can see, boom, we went from a little over 3.75% up to 3.87%. Doesn't sound like much, but in the world of interest rates and Treasury yields, it's pretty good. That's a pretty good job. And so you can see what's happened to 2-year yields on Treasuries since the act was approved. As for the yield that's going to reflect things like mortgage rates, right? So there's the 10-year Treasury yield taking quite the pop, right? And I would suggest mortgage rates popped with that upon the approval of the new spending package. And then lastly, then I'm going to go back and show you some near-term history. Here is the probability of a Fed funds rate cut at the September meeting. It's called that 160% chance of a 25 basis point cut on July 2nd, the day before the bill was approved. Fast forward to July 11th, and you get odds declining considerably. Still looking at a rate cut, and I do think we're going to get one, but down to 70% of a chance of a rate cut, and virtually all of it getting priced out despite what some folks are calling for during the upcoming July meeting. Okay, so again, my point being, as I keep repeating, be careful what you ask for, right? And then remember what happened last September, okay? And again, this is what I've shown you a few times. And that is that when the Fed indeed cut interest rates at a time when the economy was not demanding it, look what happened to Treasury yields. These would be the 2, 7, and 10-year yields. All of them popped significantly. And look what happened to mortgage rates. They went from 6.58 to 7.41. And we weren't passing big spending packages back then either. So let's talk about why that could be problematic for the stock market. Okay, so let's go back to the beginning of 2022, and I'll just run this through July of 2023. You can see right here inflation expectations spiking up big time, right? And I showed you how they're kind of doing that a bit right now. And here's how the stock market fared during that period. Okay, so yields spiked. You can see stocks fell notably. And before they were all said and done, they were down 27.5% during 2022. Only when yields finally bottomed and stabled out, so to speak, and inflation expectations came back down over concerns over the economy or what have you, did the market really find a sustainable bottom, at least sustainable to this point. That 2-year yield, okay, if we do the same thing there, you can see that yield did nothing but go up during the whole course of 2022, while the market was taking a nearly 28% hit. Bottom coincident with more or less topping out in interest rates, but you can see what the market did here when interest rates were threatening once again. And then you're going to see essentially the same thing on the 10-year, but I'll show it to you anyway. Again, here is the 10-year yield just absolutely screaming higher during 2022. And here is the stock market screaming lower during 2022. So folks, again, in closing, here's my whole point, is that we can get bullish because there's new oomph coming into the economy via government spending. And I think there's a legitimate bullish case, as I've been pointing out of late. What would be a headwind? What we're always looking for is, okay, what can go wrong? I've listened to a couple of podcasts here over the last couple of days. The one yesterday was just remarkable at how utterly bullish this gentleman is for the rest of 2025. And I listened intently because I wanted to understand his bullish case, but there was literally no room for error in his mind, meaning this is so obvious anybody in the world should know that. Well, folks, I'm going to say with all humility, that's a good thing that your money isn't being managed by somebody with that much bravado. Markets are the most humbling things ever. So having done this for 41 years, my task is always, okay, what makes sense? What's the right thesis? Where are the best risk reward setups? But then again, even with our own theses, what could go wrong? Where could we be wrong? If we have concerns about the second half of the year, where could we be wrong? What is the bullish narrative? And I painted that for you here recently, and I said this is not all that low from a probabilistic standpoint. So we need to make some adjustments to make sure that we capture enough of that upside within our willingness to take risk without adding so much risk that it could be devastating if indeed something cracks, right? 27% decline in the market that has quickly recovered is not devastation. Devastation is the 60% decline in 2008 that took a while to come back. It's the 80% decline in the NASDAQ that happened when the tech bubble burst. That one, the latter, happened amid valuations that look very much like the valuations are today, and other characteristics like concentration in the markets and so forth. Better quality company today that's going to the moon than the dot-com companies probably back then, but nevertheless, some of the same characteristics. So prudent, smart people prudent, smart money managers with experience need to take these things into account as they make these decisions. So anyway, without belaboring that any further, there is some upside risk to inflation if indeed the recession scenario or the economic slowdown scenario doesn't play out going forward. And that upside risk to inflation, as I showed you in 2022, could be a serious headwind for the market. Now, back then, the Fed was raising interest rates. They're obviously not raising interest rates right now. But indeed, if inflation really takes off due to all this, then they're going to have to. So I'll just leave it right there. Folks, again, didn't mean to interrupt your weekend, but I thought that was telling enough relative to what I've been saying here on the blog that I'd share it to those of you who are interested. Have a good rest of your weekend. Take care. Bye-bye.